As trading progresses on July 22, 2026, AT&T stock is currently changing hands at $22.98 per share, marking a notable intraday gain of 3.21% on the New York Stock Exchange. The ticker symbol T opened the morning session at $23.38, pushing as high as $24.29 during an aggressive early buying wave driven by fresh second-quarter financial results before stabilizing near current levels on massive trading volume of over 61 million shares. While retail chatter across social feeds continues to obsess over AT&T stock purely as a high-yield dividend play, the real story breaking out on trading desks today has almost nothing to do with those quarterly payout checks. The hidden driver sending shockwaves through Wall Street is a structural acceleration in converged connectivity. AT&T did not just post $31.6 billion in quarterly revenue and an adjusted operating income of $7.5 billion. They delivered their strongest consumer postpaid wireless account growth in more than 3 years, while adding over 1 million fiber and fixed wireless customers combined. Management backed up that operational momentum by accelerating their planned share repurchases to approximately $10 billion for the year. For years, the universal consensus on Wall Street was that AT&T stock was a classic value trap, a bloated legacy telecom burdened by staggering debt loads, sluggish top-line expansion, and intense pricing wars against rivals like Verizon and T-Mobile. Conventional wisdom suggested that any excess cash would be completely swallowed up by non-stop 5G infrastructure spending and wireline maintenance. Yet today's price action shows a starkly different reality. By stripping away media distractions, offloading non-core assets, and focusing exclusively on 5G wireless and fiber broadband expansion, AT&T is quietly building a high-margin cash engine that generates over $10.8 billion in quarterly operating cash flow. Looking closely at today's intraday tape on platforms like Robinhood or through an individual brokerage account, institutional buy orders have been steadily absorbing retail profit-taking. After hitting an intraday peak of $24.29, the stock settled into a tight consolidate range near $22.98. That tight spread, paired with volume surging well past its average daily footprint, signals that large money managers are taking strategic positions. Many investors managing self-investing portfolios or tracking Fidelity ETFs and Fidelity mutual funds via Fidelity Wealth Management are reevaluating where defensive value belongs in a volatile macro environment. When you look across the retail trading landscape, whether people are utilizing SoFi Invest, SoFi Active Investing, or setting up automated strategies with Schwab Intelligent Portfolios, the narrative around defensive telecom assets is rapidly shifting. For a long time, self-directed traders using the Robinhood app for Robinhood stock trading or interactive brokers' fees models viewed legacy connectivity names as dead money compared to high-flying mega-cap tech like NVIDIA stock or Apple stock. However, as broader equity markets digest shifting rate expectations, institutional capital is rotating back toward reliable cash flow generators. The technical setup on AT&T stock illustrates this tug-of-war between retail sentiment and institutional accumulation. The stock has broken cleanly above its recent trading range, pushing well off its 52-week low of $19.89 and marching toward its 52-week high of $29.79. Trading algorithms across the Interactive Brokers platform and the Fidelity trading platform picked up on the company's earnings per share beating analyst expectations at 65 cents adjusted, sparking immediate momentum buying at the opening bell. What makes this market move particularly compelling is how telecom fiber deployment creates a self-reinforcing flywheel. When a household signs up for AT&T Fiber Internet, they are significantly more likely to cross-subscribe to AT&T mobile wireless plans. This drastically lowers subscriber churn, reduces customer acquisition costs, and expands customer lifetime value. while many investors using Robinhood investments or tracking SoFi stocks focus solely on headline wireless subscriber additions. The underlying profitability per user in converged accounts is quietly outperforming traditional single-service models. To really grasp why this shift is happening, we need to take a quick step back and look at what AT&T actually is today versus what it used to be. Founded over a century ago out of Alexander Graham Bell's original telephone network, AT&T Inc. operates as a global connectivity leader headquartered in Dallas, Texas. Its core operations are split into two major segments: communications, which encompasses wireless services through AT&T Mobility, fiber broadband, and business solutions, and Latin America operations. For years, the company attempted to transform itself into a media conglomerate, spending hundreds of billions to acquire DirecTV and Time Warner. That strategy racked up massive debt and distracted from core network infrastructure. Under current CEO John Stankey, AT&T executed a complete strategic pivot, spinning off media assets, unwinding non-core holdings, and refocusing every single dollar of capital expenditure into pure fiber optic networks and 5G spectrum. Today, it stands as the nation's largest fiber internet provider and the third largest wireless carrier in the United States. Now, if you're holding this stock or watching it closely, I want to hear your take. Comment below how many shares of AT&T stock you currently hold in your portfolio, and let me know if you think their massive fiber expansion gives them a permanent edge over rivals like Verizon and T-Mobile. As we look toward the future, the primary tension for AT&T stock will remain centered on execution versus debt service. The market's lingering fear is that high interest rates will make refinancing legacy debt obligations more expensive over time, eating into free cash flow and capping upside potential. If broader macroeconomic conditions soften and consumer promotional spending escalates into a destructive price war, margins could face near-term compression. Furthermore, aggressive capital expenditure requirements for expanding fiber buildouts means free cash flow generation must remain pristine to support both the dividend and the newly accelerated $10 billion share repurchase program. On the flip side, the growth opportunity is substantial. If AT&T continues to dominate the converged fiber and wireless bundle, customer retention will hit historic highs, driving steady organic revenue growth regardless of economic backdrop. Furthermore, as legacy copper network decommissioning accelerates, operational costs will drop significantly, unlocking structural margin expansion that Wall Street has not yet fully priced into current valuation multiples. Looking across popular investing sites and brokerage apps, whether traders are evaluating options on Interactive Brokers account, buying Robinhood fractional shares, or building long-term holdings through Fidelity IRAs or Fidelity brokerage accounts, the narrative around AT&T stock is undergoing a fundamental reevaluation. The belief that AT&T is a stagnant utility stock is being challenged by the reality of a streamlined, highly focused connectivity powerhouse that is successfully pairing disciplined capital returns with consistent operational growth. At the current price of $22.98, the market is weighing a roughly 4.8% dividend yield alongside aggressive share buybacks and accelerating subscriber additions. The narrative expected AT&T to struggle under the weight of competition and capital requirements. The reality delivered today shows a company leveraging scale, fiber dominance, and balance sheet discipline to outperform. Whether that momentum carries AT&T stock back toward its multi-year highs will depend entirely on management's ability to maintain this operational momentum while keeping capital allocation tight.